Ever wondered what truly triggered the 2008 financial crisis? It all started with Louis Ranieri, who came on the scene at Lehman Brothers in the 1980s, introducing the mortgage-backed security, or private label MBS. His simple idea transformed American boring old banking into the nation's leading industry. And one day, after 3 decades, it all came crashing down. Margin Call portrays the scenario of this exact day, offering a gripping glimpse into the critical 24 hours before the crisis erupted. Based on true events, the film reveals the struggles and key decisions that led to one of the greatest financial disasters in history. In this video, you'll delve into the high-stakes world of banking, uncover the financial maneuvers at play, and gain a deeper understanding of what really happened during the 2008 meltdown. Witness how banks played the money game and why it all came crashing down. Margin Call, a 2011 Wall Street film, takes us right into the heart of the 2008 financial crisis, showing how a Wall Street firm tries to save its own skin as everything starts crumbling around them. Unfolding over just 24 hours, offering a fast-paced and intense glimpse into Wall Street's turmoil. It shows the ruthless, unethical side of the industry without turning its characters into caricatures. Those 24 hours started with the bank carrying out a massive staff cut that affected nearly all its departments. Around 80% of the staff in the risk analysis department were laid off that same day. In just 24 hours, the bank had cut over 40% of its total workforce. Among those affected by this drastic staff reduction was Eric Dale, the head of risk control. Dale's main concern was to transfer a confidential file he had been working on to someone who could understand the information it contained about the bank's operations. By a lucky chance, the recipient was Peter Sullivan, a relatively new analyst with a strong engineering background that gave him the necessary mathematical skills. After carefully examining the file, Sullivan realized it revealed an imminent financial disaster for the bank. The analytical model showed a systematic and excessive increase in the volatility of the mortgage-backed securities market, far exceeding the maximum limits considered in the bank's usual operations. This surge in volatility, far from being an isolated event, was a sign of massive losses that threatened to completely wipe out the bank's capital, leading it to insolvency and bankruptcy. But why was the volatility of the mortgage market so critically important in valuing the bank's assets? To fully understand the crisis shown in the movie, we need to examine how the investment bank operated and its connection to the subprime mortgage issue that triggered everything. Louis Ranieri introduced the mortgage-backed security in 1977. It was a simple idea: combine all the mortgages into one bundle. With thousands of mortgages bundled together, the yield goes up, meaning investors can expect higher returns while the risk remains small because they were mortgages. And who doesn't pay their mortgage? The credit rating on these bonds was based on the borrower's credit scores and their ability to repay the loan. In the years leading up to 2007, the US housing market was booming, fueled by lax lending standards that allowed even borrowers with poor credit scores to obtain mortgages. These subprime mortgages had higher interest rates to compensate for the increased risk of default. When a bond was considered too risky, banks were busy earning large fees from selling them, so they couldn't reject them. Instead, they repackaged them with other unsold assets into CDOs, collateralized debt obligations. This involved taking a mix of B-rated bonds, including subprime mortgages, and bundling them together. Once the bundle was large enough, it was deemed diversified, and rating agencies often gave it a AAA rating. These CDOs were a key factor in turning the housing crisis into a nationwide economic disaster. Investment banks like the one in Margin Call capitalized on the trend by bundling thousands of mortgages, including subprime loans, into mortgage-backed securities, MBS, to sell to investors. This securitization process allowed banks to offload mortgage debt while earning lucrative fees. The profits from originating, packaging, and selling these MBS were irresistible. Lenders became less careful when giving loans because they could sell them to investment banks, leading to riskier lending practices. This made it easier for people to get loans they couldn't afford, causing bigger problems later. Initially, this strategy allowed for the successful sale of these instruments. However, As defaults on subprime mortgages rose significantly in early 2007, confidence in the mortgage market collapsed. What seemed like a manageable risk turned into a crisis of confidence. Investors lost interest in mortgage-backed assets, freezing the market. Peter Sullivan discovered from Eric Dale's data that the assumptions underlying MBS pricing models were catastrophically wrong. The models failed to consider a nationwide housing downturn and defaults on subprime mortgages. As home prices fell in 2006 and 2007, defaults soared on risky loans given with little scrutiny during the boom years. This exposed that the AAA ratings assigned to many MBS were wildly inaccurate assessments of their risk. In the 24 months leading up to the events of margin call, the investment bank, like many others, was aggressively creating subprime mortgages. They bundled these mortgages into securities, sold them for fees, and kept some of these mortgage-backed securities, MBS, on their own books, relying on flawed risk models. The bank took a big risk by creating these funds because there was a chance they couldn't find buyers. If they couldn't sell them, the mortgages would stay on their balance sheet indefinitely, leading to financial problems. To prepare for this, the bank estimated the maximum losses it could face from holding these assets long-term, using the highest volatility of the asset's value in the markets. Understanding this requires some basic concepts of investment theory. Let's start with VAR, or value at risk. VAR measures the most money an investor or bank could lose in a specific time period, based on past price movements. Banks use VAR to manage risk, not to predict profits. If the VAR is high, it means the bank could lose a lot of money, so they might adjust their investments to avoid big losses. VAR tells us how much money a bank or any investor could lose over a period of time. In finance, there's also the concept of a risk-free rate of return, like the yield on government bonds. On top of this, a risk premium is added depending on the risk level of an asset. Higher risk means a higher premium and a higher expected return. If an asset's price is very volatile, investors see it as riskier and demand a higher return. In margin call, the bank used historical data to estimate the maximum volatility and risk of their mortgage-backed securities, believing they could manage the losses. However, Eric Dale's analysis revealed that the real risk was much higher, indicating that the bank could face massive losses, threatening its survival. This happened because the bank was too focused on profits from risky subprime mortgages, and when the truth about the volatility and potential losses came to light through Dale's analysis, it threatened to bring down the entire firm. The information on the USB drive reveals that market volatility has skyrocketed above historical maximum levels, and this is now a permanent condition, not just a temporary trend. As a result, the risk associated with the operations currently on the bank's balance sheet is that potential losses from the unsold mortgages they created are much higher than initially calculated. They are so significant that they would wipe out the bank's entire equity capital, inevitably leading it to bankruptcy, and bankruptcy equals disaster. Once Peter Sullivan discovers this reality in the data and shares it with his bosses, Will Emerson and Sam Rogers, the news spreads up the chain of command to the Chief Financial Officer, Sarah Robertson, the CEO, Jared Cohen, and finally to the President, John Told. When everyone gathers to find a solution, the bank president's plan is simple. Sell all the mortgages on their books to investors and other banks in one morning before the market realizes these assets are worth much less. This is to prevent potential losses from becoming real ones. However, it's hard to believe a bank could realistically pull off all these transactions in a single day without raising suspicions due to the high volume. The movie assumes the bank succeeds in its plan. While Margin Call captures the essence of the global financial crisis, it takes some dramatic liberties for storytelling purposes. The solution portrayed in the movie doesn't fully reflect the complex reality of the market. However, it shows how investment banks sold risky mortgage bundles without fully disclosing the risks involved, closely tying to real events. Banks, backed by government guarantees to protect depositors' funds, took excessive risks, confident they wouldn't face bankruptcy. Additionally, banks sold investments that didn't appear on their balance sheets, meaning potential losses would mainly affect investors rather than the banks themselves. This led to the widespread distribution of financial assets whose risks were underestimated by investors. The film vividly portrays the frantic trading scene as the bank tries to offload its toxic assets. In a crucial moment, Sam instructs his traders to accept only cash deals, emphasizing the bank's desperate need to exit this crumbling market. As the day progresses, the rapid decline in asset value is starkly illustrated, with prices plummeting from 93.5 cents on the dollar at the start to just 65 cents by the end. This dramatic drop highlights the crisis's speed and the enormous financial losses across the market. While the timeline of events was longer than shown in the movie, the core issue depicted in Margin Call remains the same. Reflecting the prevailing attitude, the bank's president remarks that to succeed in finance, you have to be quicker, smarter, or lie. So, did it happen in real life or not? It's hard to conclude definitively. The story seems to align with Lehman Brothers, once the fourth largest investment bank, which went bankrupt in 2008 due to subprime mortgages. The parallels are striking. Lehman's CFO was also a woman, Erin Callan, and its president was fooled, similar to told in the movie. In reality, their collapse was the catalyst for the worst financial crisis since the Great Depression. Even if the Federal Reserve and Treasury had rescued Lehman, a similar collapse of the system and markets would likely have occurred, just over a longer period. The reason for its bankruptcy was similar to what caused Bear Stearns to be acquired by JP Morgan Chase at a low price earlier that year, and why efforts were made to inject liquidity into Fannie Mae and Freddie Mac before they faced collapse. Lehman Brothers lost nearly half of its stock market value in just 2 days due to quarterly losses from depreciating debt portfolios, putting its survival at risk. The bank tried to stabilize by claiming it was negotiating with potential buyers. However, these talks failed, and doubts about its survival only sped up a collapse that seemed inevitable. They tried to find buyers to stabilize their situation, but it didn't work out. This uncertainty led to a quick collapse. The Federal Reserve and Treasury Department urgently met with Wall Street to find solutions, but decided not to help Lehman, which made things worse. The Federal Reserve and Treasury held an emergency meeting that weekend with Wall Street bankers to discuss solutions, with over 29,000 employees worldwide waiting anxiously. One option discussed was splitting the firm to separate healthy assets from those burdened by toxic mortgages. On September 15, 2008, at 7 in the morning, Lehman Brothers filed for bankruptcy. At that time, it had assets valued at $639 billion, but was also burdened with debts totaling $613 billion. This bankruptcy was a landmark moment in modern financial history. The next day, the British group Barclays acquired a significant portion of Lehman's operations for $2 billion. In the end, the movie is right about something. There's not much difference between finance and gambling. Basically, Wall Street is a giant casino, where for one person to win, someone else has to lose. What if I told you a group of weirdos saw this biggest financial crash coming and made millions from it? They bet against the housing market, challenged the banks, the government, and the SEC, and came out on top. Based on a true story and real events, watch this video on The Big Short to learn how they did what no one ever thought possible. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies, all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.